Thank you for joining me for Verity Credit Union's Health Savings Accounts 101. This is going to be a high-level overview of health savings accounts, how they work, what are the advantages, how they work with qualified high-deductible health plans, which is your HSA qualified plan option, and give you some tips on how best to choose between the medical plans to decide which one is best for you. So let's jump right in. So what are health savings accounts? These are special savings accounts that can be combined with qualified high deductible health plans. That's your HSA qualified plan choice. And they're powerful tax savings tools that allow you to set aside funds in this savings account that can be used for qualified expenses now or in the future. Now, because of those tax advantages that HSA plans offer, there are some eligibility requirements that the IRS has set that you have to meet before you can open an HSA account. So first, you have to be enrolled in a qualified medical plan. So your open choice HSA, that plan qualifies. You can't be claimed as another person's tax dependent. You can't have other first dollar coverage, so that's going to be coverage that will pay for your claims while you're in the high deductible portion of your medical plan. And you can't be covered by a traditional flexible spending account because that's considered first dollar coverage because it does pay for medical, dental, and vision expenses. Now, the exception to that is that there are limited purpose FSAs, one of which Verity offers, and because those only cover dental and vision expenses, that will not disqualify you from being able to contribute to a health savings account. There are a lot of advantages to being able to open and contribute to a health savings account. The contributions that you make into the account, the interest earned on those contributions, and any distributions that you take out of the account for qualified expenses are all on a tax-free basis. The account and the funds in it are yours whether or not you change employers, you change plans, or you retire in the future. You get to continue to use those funds even if you are not enrolled in a qualifying plan. There is no use it or lose it rule that requires you to use up the funds by a specific date. You can let them grow in the account for future expenses without having to worry about having to take them out. And there's a lot of flexibility in the contributions and how you use them. So you get to decide how much to contribute during the year, from zero up to the annual max, and when to actually use the funds for qualified expenses. Now, you may be wondering where the contributions for these health savings accounts come from. Well, you as the employee are the primary source for those contributions. It's your account. So you can make contributions through payroll. That means your contributions will come out on a pre-tax basis and go right into your account. And you get to decide how much. You can contribute anywhere between zero and the annual max every year. Family members can also help fund your health savings account. They won't receive any of the tax benefits. It's your account, so you receive them, but they can certainly help you grow your balance. And the IRS sets annual limits every year. So there are an individual limit. So if you are enrolled as an individual by yourself, no dependents, then you have an individual annual max. If you are covering family members, you have a higher annual limit that you can contribute to. And if you are 55 or older, you get to contribute an additional $1,000 above whatever that annual max is for the year that you turn 55 and every year thereafter. So how does the HSA work? Well, you're going to use your HSA to pay for qualified medical, dental, and vision expenses. You have the option of paying your provider bills directly from your HSA account, or you can pay for those out of pocket and then reimburse yourself. Any qualified expense that's been incurred after you've opened up your health savings account can be reimbursed at any point in the future. There's no time limitation on those reimbursements. Now remember, you have the choice of using those funds or allowing your HSA balance to grow for expenses that might occur in the future. And these accounts are self-managed, so you're not going to submit claims to a third party. It's up to you to know what is or isn't qualified expense, and you need to keep the records that back up all of the distributions that you've taken from the account to show that they are qualified expenses. The only time a third party will look at your health savings account is if you are audited by the IRS, at which point you are going to want to make sure that you can back up all of those distributions. Okay, now you're probably wondering, well, is a health savings account right for me? Well, before you can determine that, you need to decide whether or not a qualified high deductible health plan is the right choice for you and your family. If you're enrolling dependents, you're going to have a larger deductible, and that larger deductible is going to need to be paid before coinsurance applies. So you're going to have all claims applied to your deductible before you have just a 20% cost share. And you want to look back at the claims you've had over the last couple of years as an indicator of what to expect in the coming year, and whether or not there is anything that is planned for the coming year as far as a large medical expense. So enrolling in a qualified high deductible health plan is a great way to take advantage of lower premiums, but it also involves looking at your risk tolerance and how comfortable you are with that larger deductible. So what can you expect with an HSA qualified plan? Now, your in-network preventive claims, those are paid at 100%. There's no cost share, and that's actually the same for either plan that you choose. All other covered claims will go to your deductible under the HSA qualified plan. So regardless of the type of claim it is, it gets applied to your deductible. And once your full deductible's been met, that's when coinsurance begins, and your cost share is just 20% until you reach an out-of-pocket max. If you are enrolling family members, that means you have a family deductible, which is going to be larger, and that full family deductible has to be met before any of the claims are covered with coinsurance. And while you're in that deductible portion, that's a great time to use your HSA dollars to help pay those provider expenses. Okay, there are some questions that you can ask yourself to help to determine your risk tolerance or your comfort level with being enrolled in a qualified high deductible health plan or HSA qualified plan. Most importantly, are you prepared for a large claim that might happen at the beginning of a plan year when your deductible hasn't yet to be met, or you haven't saved up enough in your health savings account to help offset that unexpected large expense? What are the actual costs of claims that you anticipate having? So do you have regular office visits that you go to, or do you have regular prescriptions? You want to find out what the actual costs of those are, because that's the amount that's going to get applied to your deductible. So looking at your explanation of benefits in the past, that will tell you what that provider bills for a particular service. It'll show you the allowed amount, so the portion that they have to write off is their provider discount, and then the portion that's actually processed is the claim. And that's going to be the real cost of that claim that would be applied to your deductible. So you can always talk with providers and get information from them, but your EOBs are going to be your best source of information of the actual out-of-pocket costs. Now that you've got some questions to ask yourself about what your claims have been in the past, what is your tolerance for having a higher deductible, you want to take that information that you've gathered and you want to run those claims through each of your plan choices, your open choice PPO plan and the open choice HSA plan. And remember, with that HSA plan, everything's going to go to the deductible first and then coinsurance. And the next step is to determine whether or not you will be enrolling your family members and do the same with their claims. And remember, with the HSA qualified plan, you have a family deductible. That full family deductible has to be met before any claims are covered by just coinsurance. And then you're going to compare the results. Which plan results in the highest out-of-pocket expenses? And then you want to look at cost shares. You have a cost share to enrolling dependents, and if you are enrolling yourself only, there is a cost share to being in the PPO plan versus the fully paid coverage for the HSA qualified plan. Add those costs to the claims costs too, because that's part of the expense of being enrolled in the coverage. And hopefully at this point, that may have changed the outlook and it will be very clear to you which is the better plan for you. If that hasn't made it clear, then now is the time to look at the benefits of the health savings account and the advantages that having that offers. So remember, you can take the difference in cost share between enrolling in the PPO plan versus the HSA plan, add that to your health savings account each month and get those immediate tax savings. You've got the flexibility and the opportunity to save for future and current expenses with the health savings account and save on the taxes every year because of those contributions. So the advantages of that HSA may be just enough to help you decide between the two plans and which will be best for you and your family. Okay, so now you have a high-level overview of health savings accounts, how they work, what to expect from them, and the qualified high-deductible health plan or HSA qualified plan that you'd need to enroll in first in order to have that HSA. We've given you tools to think about the claims that you've had and you anticipate having and how to evaluate each plan and what your out-of-pocket expenses would be. And remember that that's the first step. That's the most important part of this decision making. You want to choose the medical plan that works best for you and your family. If you end up choosing the HSA qualified plan, then opening a health savings account is a great tax savings tool and it will make that plan even better. But that shouldn't be the deciding factor between the two plans. If you have questions, we want to make sure that you get those answered. So please reach out to Human Resources. Verity's got a great HR team. They're there and ready to help you with any questions. And remember that you can reach out to Brown & Brown as well. Stephanie Kuntz is your account manager, and she's available to answer any questions regarding the plans or HSAs as well. Thank you for taking the time to listen to this webinar. I hope that it's been helpful and that you can now make your best plan choice for you and your family. Thank you and have a wonderful day.